Hi viewers, and welcome to another edition of StockTrek. My name is Philip Bish. I'm an analyst here at Intelligent Investor, and joining me today I have Mitchell Sneddon, a fellow analyst. Welcome, Mitchell.
Thanks, Phil.
Thanks. Today we're going to be talking about listed investment companies, LICs. So firstly, Mitch, what is a listed investment company?
Well, basically it's very similar to a managed fund, except there's two letters in the name of it that gives it away. The L, listed, and the C, it's a company. So that I guess differentiates it from your typical managed funds. So the structure is a closed-ended structure. So a manager will go out there and do an initial public offering, an IPO, to raise X amount of money. Let's say sets out to raise 200 million and does that. Then that goes into the company structure, of course, which is closed-ended. So once the funds have been raised, they're with the manager, and that's it. You know, the only times it'll go back to the investors is through dividends, or if the LIC itself winds up and gives the money back to investors. Whereas with a managed fund, you've got an open-ended structure. So cash can flow in, cash can flow out. So the reason why I do like LICs when they work properly and in the best interests of the shareholder is because that closed-ended structure can give the manager a lot of certainty. So they don't have to worry about inflows and outflows at the top of the market or the bottom of the market. They don't have to worry about keeping up with redemptions. They just worry about setting their portfolio up, hopefully with a long-term focus in mind, because having that locked-in structure allows them to think about the long term and think through not just the next quarter and putting good numbers on the board for their clients, but for years and years to come. So and also because it's a company structure, it can actually pay out dividends much more efficiently than, say, a managed fund, which is like a unit trust. The trust structure has to pay out all realised earnings throughout the year to its members, whereas a listed investment company can smooth out the dividends. It can retain earnings like a company does, and then pay them out over time. So you see a really good example of that is the likes of AFIC, Argo, Milton, DUI, AUI, and BKI. Through the GFC, their dividends didn't change. They held them steady. When a lot of others were cutting theirs, their dividends just stayed nice and steady and then continued to rise afterwards. So that's the benefit of that company structure.
Okay, fantastic. So when you buy, or when you get to buy a LIC, what are the key things that you look for?
This is something that I look for when it comes to any kind of managed product, be it a listed investment company or a managed fund. I need to first know how the manager invests and know the strategy behind it, because and understand it, because if I don't know it and if I don't understand the strategy, then I don't care what they're doing. I'm not going to be comfortable with it. So first I look at is something that I agree with and something that sits well so I can sleep easily at night. Then you've got to look. You do have to take into consideration the fees. Now, you know, I don't put a massive focus on the fees because if the portfolio performs well, then the fees are justified. But the reason I do look at the fees, though, is to try and tell me what kind of percentage of a discount to the share price needs to be to the underlying assets of the listed investment company that I need to pay. The bigger the fees, of course, the bigger the discount I want to see. The likes of the internally managed LICs out there, so the AFICs, your Argos, the big familiar names, their management fees are minuscule. They're cheaper than most exchange-traded funds out there, and that surprises a lot of people, and you're getting a managed portfolio for it. So I don't need a big discount. When it comes to your externally managed LICs, so where a fund manager is managing the portfolio but charging a management fee and potentially a performance fee. On top of that, the LIC is also wearing the expenses of being a listed entity with board fees, directors' fees, etc. I'm expecting a bigger discount to its underlying assets. So that's another thing I take into consideration.
So in terms of their performance record,
Yeah.
what do you look at in terms of a performance record? How far do you go back?
Yeah, this is an interesting one. I tend to look at a performance, and you'll see everywhere you go, funds management land and investment land in general, the saying past performance is no indication of future performance. And it's 100% true. But what I do like to see a team who's been able to perform though, and I like to see that as long as possible. So some people for some reason say they don't like to look past 5 years, but if they've got a 10-year track record, I want to see it. And what the performance does tell me is that the process that they have in place is actually working, the stock picking process and the portfolio management process. And it's not just working through the cycles of the market, so the ebbs and flows of corrections and whatnot, that certainly the volatility that we've seen right now. But it shows me that internally, because these are companies, staff come and go as they do, analysts come and go, they get poached or new ones come in. You need a robust structure and a process in place to be able to support that change within the business itself. So the longer the history, the more that I can see that the process works and can withstand the market ebbs and flows and just the daily comings and goings of business.
Okay, Mitch, in August you made a big call to sell WAX, which would have been a very hard decision seeing it's performed so well. Are you still comfortable with that call?
Very much so at the moment. WAX, if you look at the share price compared to the net tangible assets, is still significantly above those. Even though the share price is now only just sitting slightly below where we said to sell. But it's a very similar story to when we said to sell Cadence Capital. The share price was going one way, the underlying value of the portfolio was going another with Cadence, and so far that's been a good call. And there was just such a growing disconnect. It just simply, for pure value, couldn't be ignored. Now the market is still in love with the Wilson Asset Management LICs, and they're happy to pay up for them at the present time, but we're not in that camp.
Okay, good. Thank you, Mitch. So now that you've sold WAX, you've got a bit of extra cash in your model portfolio. Do you have any plans to use that to buy another LIC? We
are certainly. I'm always looking around the market, but and the hole that WAM Research has left is in that mid-cap space. We don't have a lot, mid to small cap, I should say. We don't have a lot of exposure there. PIC has a bit, but not as much as what I would like. But the decision to sell WAX came at the time when the mid to small caps had ran really hard, and so there wasn't a lot of value lying around out there. I certainly wasn't prepared to pay up for it. If I was happy to sell WAX, I couldn't really go out and buy another overvalued LIC. So at the moment, still looking around. There's plenty coming on the market. I'm avoiding the IPOs. I would love to see something like Mirrabooka cheaper. That could fill the gap really nicely. It also has a bit more liquidity as well, because that's another issue that you get with a lot of these LICs. There's a whole stack of them out there, sub 200 million market cap, and they're just incredibly difficult to buy, so you need to keep that in consideration. But so we are looking, and we will find something in that mid-cap space, but I'll tell you what, right now having the cash sitting there in the portfolio certainly hasn't hurt.
Okay, thank you. So with the current portfolio, I think you've got 6 LICs in there at the moment. Do you have any updates on any of the LICs? They're
kind of all tracking along as they're meant to be. Look, Magellan Flagship, or MFF, it's had its ups and downs. I think going as low as, say, approximately $1.68 or so. It's now rebounded from that. But it's well off its highs of, I think, around $2.12 it got to at one point. it's something that we've still got a lot of confidence in. A lot of confidence in Chris Mackay, the manager there. It's a high quality portfolio of the likes of Visa, MasterCard, Lowe's, Home Depot, a couple of the banks over there in the US. And it's really filling that international space quite well for us, so I'm happy with that. But you do have to wear the ebbs and flows, the volatility that we're experiencing there. BKI is another interesting one. I mean, for different reasons. It's externalised the management. Now, when a lot of people hear that it's gone from an internally managed LIC to an externally managed LIC, they get a bit worried because externally managed LICs tend to be with fund managers who charge fund management style fees, which are generally 1% plus performance. BKI is very different. They've externalised it to Tom Milner started a management company with his offsider, and basically it's called Contact Asset Management, and what they're doing is they've started that to lock in the MER of BKI, and so they can look to grow the management company, which BKI will benefit from, because when they grow the management company, they'll be able to employ other analysts and whatnot and get some broader coverage. And so BKI should benefit from the extra manpower that they'll be able to bring to the table. What's interesting as well, and perhaps this could be something for our cash to look at down the track, if no other opportunity presents itself, is Contact Asset Management will be looking to launch, well, I need to cut that. Contact Asset Management down the track may look to launch something in the small to mid cap space that could be attractive to a lot of investors if they keep that BKI theme of a real low MER, and it could be quite a disruption to the mainstream investment or LIC world. The other ones that we're keeping an eye on at the moment, of course, Thorney Opportunities Fund is in the portfolio. It's ticking along really nicely. I think we brought it into the portfolio at around 40 cents. It's now sitting at 70. So still really happy with that. Just a little bit below its NTA, but when you take into consideration the fees, we're happy to hold there. And Perpetual as well, PIC, is tracking along just as we expected. PM Capital Asian Opportunities Fund, still languishing a bit, but it's in a volatile space. We're still at a very deep discount for us.
Thank you very much, Mitchell, and thank you, members, for joining us for this week's Stock Trek.